Welcome to our Taking Stock episode for the week ending the 13th of March, 2026. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome, Matt. How are you today?
I'm going okay under the circumstances, Kien. It's good to be joining you again.
Yeah, great to have you on board and sharing your insights, especially around all this volatility at the moment. But before we begin, just a reminder that the information discussed is of a generic nature and does not take into account your personal financial circumstances. You should consider whether the information is appropriate for your situation before making any investment decisions. And also, Stock Doctor, as part of the Prime Financial Group, if you require assistance with other services like superannuation accounting or diversifying your investments into property or alternatives, please reach out to one of our customer service teams on that. But Matt, the Middle East conflict, that remains a hot topic at the moment, with Iran now threatening further attacks on oil tankers and disruptions around the Strait of Hormuz, a key shipping route for global energy supply.
Yeah, that it is, Kien. Look, in short, I think the Trump administration has pretty much thrown the region into total chaos. There's their seeming inability, I think, to articulate their military objectives gives us very little clarity at the moment as to what we can expect with regards to the duration of this conflict. And Iran has obviously been hit quite hard, yet they do appear still to have meaningful capacity to threaten traffic across the strait and effectively target US bases across the Persian Gulf, throwing those Gulf states into extreme uncertainty. Military analysts have pointed out that they have sea mines, cruise missiles, drones, and fast attack boats, which are relatively inexpensive to build but effective tools in a narrow waterway. And this is all contributing to highly elevated oil prices.
Yeah, that's right. And of course, it's feeding into higher inflation and interest rate expectations. But the challenge for investors, though, is that we simply don't know how long this conflict may last or how it might evolve. Outside of the US and Iran, major energy consumers like China and India, they also rely heavily on these flows. So a prolonged war would be devastating for the global economy. And given that it's a lose-lose scenario here, we expect the global pressure will lead us to a permanent off-ramp. But history does show that geopolitical shocks, they create short-term volatility, but they rarely determine long-term market outcomes. Rather than try to time geopolitical events, investors are usually better off focusing on what they can control, and that is portfolio risk management and stock selection.
I think that's right, Ken, and that means maintaining diversification across strong businesses with durable competitive advantages. Companies with economic moats are often better positioned to navigate inflation, rising costs, or economic slowdowns. Keeping some cash available can also allow investors to take advantage of opportunities.
Yeah, that's a good point there, Matt. But let's now turn our attention to some star stock highlights over the reporting season. We recently initiated coverage on IRESS, a financial technology company providing software used by brokers, financial advisors, and wealth managers.
Yeah, certainly a platform that we use here at Lincoln, particularly in the managed funds business. And it's a platform that supports trading, portfolio management, market data, and regulatory compliance. Because these systems are embedded in client operations, they tend to generate recurring revenue and long-term relationships. However, the company did go through a very difficult period in 2023, didn't it, Cam?
Yeah, that's right, Matt. I mean, back then the business became too complex following years of acquisitions and was carrying a high cost base. And that eventually led to a major impairment, especially in their UK operations. And all this contributed to their weak financial health back then.
Yeah, that it did, and it was also subject to cybersecurity breach in 2024, which did raise concerns about how the company protects its client data. In response, management did launch a major transformation program aimed at rebuilding trust and improving performance. That included simplifying the business, selling non-core divisions, and focusing on two core segments. It's wealth software and trading and market data.
That's right. And we're now starting to see the benefits of that restructuring flow through. The simpler operating structure and also lower cost base has improved the profitability, with the return on equity now risen to around 18%. And looking ahead, management do expect double-digit earnings growth supported by ongoing efficiency gains, stronger client engagement and continued investment in new technology and also AI-driven products. And moving on, another interesting initiation to our Star Growth stock universe is SKS Technologies. SKS is Australia's contractor that designs and installs electrical communications and audio-visual infrastructure across sectors like data centers, corporate facilities, and government projects.
Yeah, and growth has been driven largely by the rapid expansion of data center construction. As cloud computing and artificial intelligence continue to expand, demand for digital infrastructure is increasing significantly.
Yeah, quite a strong thematic at the moment, Matt. But one interesting aspect of SKS is its very high return on equity, around 74%. At first glance, though, that might seem unusual given that net profit margins are relatively modest. But the explanation lies in the company's capital-light business model.
Yeah, electrical contracting businesses typically require very, very little capital investment. They rely more on labour and project execution than large physical assets, which means profits can generate very high returns on equity, albeit with low operating profit margins.
Yeah, good analysis there. And another positive factor, though, is we see with this company is the management alignment. The business was founded by brothers Peter and Greg Jinks, who remain involved today. Peter holds around 9% of the company, while Greg owns roughly about 11%, and that provides meaningful skin in the game and alignment of shareholder interests. And now for Under the Microscope. This week we're looking at medical technology company Polynovo. Now, they develop synthetic wound treatment products used for severe burns, trauma injuries, and reconstructive surgery. And their flagship product, NovoSorb BTM, that's a synthetic scaffold that helps the body regenerate skin before a final skin graft is applied. Now, because the material is fully synthetic rather than derived from biological tissue, it offers consistent manufacturing quality and reduces infection risk.
Yeah, that does, Kien. And demand for these treatments is increasing globally due to aging populations and rising diabetes rates, which often lead to skin ulcers and advances in reconstructive surgery. Growth has largely been driven by the US, with Polynovo working on approval from the FDA for another product to treat full thickness burns, the most severe type of burn injury, and this could support wider hospital adoption. Another driver of growth is the expansion of the company's sales network in the US. But despite this strong revenue growth, the share price has declined over the past year. What's happened there, Kien?
Yeah, good question, Matt. Several factors have contributed to that weakness. You've got the company, they went through a period of governance disruption following leadership changes and board turnover, which unsettled investors. At the same time, Polynovo had been investing heavily in regulatory submissions and expanding its commercial footprint, particularly in the US, which did temporarily weigh on their margins.
And that may help explain why short interest is quite elevated at around 12.5 times of shares on issue. Some short sellers may also be concerned about the timing of regulatory approvals, reimbursement outcomes within the US healthcare system, and the pace at which hospitals and surgeons adopt new medical technologies.
Yeah, definitely keep that in mind. But as a result, analysts' consensus do suggest that the stock now is trading below their estimated fair value based on consensus. But that could present an opportunity for investors attracted to the long-term growth story here. However, it's also important to remain vigilant and be mindful of the risks, including slower than expected surgeon adoption. It needs regulatory approval, which can be delayed, and of course, execution risks as the company scales manufacturing and global distribution. And now for question of the week, which we often get asked, especially from our members following the reporting season. But with so many star stocks emerging now, how do investors construct a high quality portfolio?
Yeah, very good question with about 53 star growth stocks, I think, at the moment, Kien. But the first step is to determine your investment objectives, whether you're investing for growth, income, or have a more balanced type of approach. But once that's clear, you can use the portfolio constructor within Stock Doctor. The tool allows you to enter your capital amount, the number of stocks desired, and investor profile to generate a list of suitable star stocks.
And also, members can also refine the portfolio by excluding sectors or by selecting trend-sensitive options where only stocks with their exit signals on the SD30 TSR are included. From there, it's important to review the analyst commentary and also understand the outlook and risks for each company as well.
And for those who just want to update their portfolio, you can use the Portfolio Optimizer. This analyzes your existing holdings and suggests ways to improve the balance between return and risk within each portfolio. Ultimately, investors don't need to own every single star stock, just the ones you're comfortable with, but ensure you are diversified across at least 15 stocks.
And of course, if you wish, you could also invest in all our star stocks to replicate the existing performance. And that brings us to the end of this week's episode. Matt, thanks for your contributions.
My pleasure, Kien.
And if you do have friends or family who you believe would benefit from Stock Doctor, please feel free to share our referral link to them. We grow and innovate because of you, our supporters. Until next time, have a happy, healthy, and prosperous week ahead.